Hi, welcome to the return of AJ Bell's monthly bonus podcast, all about investment trusts. So for those new to the show, we publish extra podcasts alongside the weekly Money and Market show. This one is dedicated to all things related to investment trusts. My name is Dan Coatsworth. I'm pleased to introduce a new face to the show. Hello, Hannah Williford.
Hi, it's great to be on the podcast.
So Hannah joined us earlier in the year. You might have read some of her articles on the AJ Bell website. She's done such a great job. She's now going multimedia and taking Leith's seat on the Investment Trust pod. So Leith fans, you can still relax. He's still with us. He's just really busy doing his deep dive podcast. So they're an amazing listen. If you haven't heard, please go back and delve into the archives. Some really good stuff there.
So we've got some great guests on this week. We're going to be talking to Dan Higgins from Majedie about bringing university-style endowment investment to the public. And there's some intriguing stats showing a sudden spike in interest for all things ESG.
I'll also be looking at investing in the UK following a great run from the FTSE 100 this year. So I'll be chatting to Ian Lance from Temple Bar about how he's delivered supersized returns. We'll also hear from James Harries from the STS Global Income and Growth Trust about why the UK is such a big part of his portfolio.
Before we explore those topics, we thought it would be useful to give a 60-second reminder of exactly what investment trusts are. We've had quite a few new listeners recently, and the investment world isn't always the most straightforward.
Yeah. So, I mean, in a nutshell, investment trusts they're very much like a fund, but it's essentially run by a company. So they will go out and be run by a manager, and they'll pick individual stocks, or you might have other assets inside, and they make the decisions about what goes in and out of the portfolio. Lots of investors like investment trusts because many of them trade for less than the actual underlying value of the assets that they hold. Now, we've done quite a few episodes to explain why those discounts happen, and we will definitely come back and revisit that subject. But really, they just think of them are a type of fund, but they trade on the stock market and their price moves throughout the day. All right, so let's talk about one of the big topics in the investment trust world. And actually, it's the topic that we started the year talking about, and it's all about activist investors. And in particular, it's about the return of someone called Saba. It's an American entity. It's been targeting the UK sort of investment trust world, trying to look for opportunities. So Hannah, take a couple of steps back. Let's revisit what exactly what's Saba trying to do, and then we'll explain why it's back in the news again.
Yeah, so last January, investment trusts took the spotlight for the first time in a while. US hedge fund Saba Capital started stirring up the investment trust world a bit by basically using their stakes in companies to call for votes and change how the trusts would operate. The main issues they were raising were about kind of the performance of the trusts, the discounts, and how shareholders were able to withdraw the money. And to be honest, there was some good bits of truth and in these complaints, and the industry has really struggled in the past couple years. But there were a lot of concerns that Saba could have a more insidious motive and may have planned to take over management of the funds themselves. We didn't really find out if this would happen because the investment trust industry really rallied their shareholders, and each of the 7 trusts Saba targeted rejected their proposals.
I mean, I think it's fair to say that whilst those 7 campaigns didn't work, actually they had a really big impact on the investment trust industry as a whole. Essentially, it meant that sustained underperformance would no longer be tolerated by investors. So we've seen boards of directors of these different investment trusts. They've all had to sort of sit up, take notice, and essentially sort of say, you know, we just can't let suboptimal performance continue. So we've seen manager changes. We've seen some of these trusts merge with each other, trying to gain scale. Some have just gone to shareholders and say, should we continue? And some have sort of basically went, no. The shareholders are saying, no, we're just going to be wound up. So I think that whilst Saba didn't succeed in its direct campaigns, overall the industry has been, really shaken up by it. And so what's happened since then, since those 7 campaigns, Saba's done a couple more sort of more quietly ones, but more recently, it's taken a 5% position in a trust called SDCL Energy Efficiency Income. These are one of the many trusts we've seen in the renewable energy infrastructure sector that languishing on a really big discount. So when that news came out a few weeks ago, Saba didn't come out and sort of say, like, this is what we want to do, but it's not really hard to guess. It's trying to buy into trusts that look really cheap and to push for something that will change that situation, i.e. narrow that discount. It's just trying to make some money along the way. And plenty of investors have done this, but Saba's doing it by taking a really big stake and hopefully sort of, from its perspective, it thinks that that's enough to push pressure on to the management team. So now SDCL is not the only one. We've also had news that it's taken a stake in Smithson. So Hannah, I know you've been looking at this trust in more detail because there's a name associated with Smithson, which I think even if our listeners are only follow the investment world, casually, they might be familiar with this name.
Yeah, absolutely. So pretty much as close as you can get to a celebrity in the investment trust world. The Smithson Investment Trust is managed by Terry Smith. And this has kind of caused quite a bit of a shakeup because, frankly, the past couple of years have not been the best for this trust. And basically, if the discount remains over 10% for the calendar year, the rules of the trust say that it has to have a continuation vote. Now, where Saba comes into play with this is they have built up their stake in the trust now to 14%, I think 14.1 actually, and it means that they are the largest single stakeholder for that trust. So if this continuation vote happens, it could be a really strong entry point for Saba to try to campaign for some change again. So yeah, there's definitely a little potential for some deja vu for the investment trust industry coming up. But as you said, it has kind of changed the precedent for what is okay. And it has also definitely really made investors engage a lot more and get a pretty clear understanding of what's going on with their investments. So definitely some positives there, but will be an interesting one to watch.
Yeah, I think it's probably worth just pointing out that so Terry Smith doesn't actually manage the day-to-day running of that trust. He's sort of the overarching figure of Fundsmith, the asset management firm. Smithson's one of their products. It actually has, it's another manager, Simon Barnard, doing those portfolio decisions. But I think everyone associates it with Terry Smith because at the end of the day, his name is above the door, in terms of sort of Fundsmith, it's his business. And so I think people are sort of going, well, hang on a minute. Terry Smith's meant to be this guy that knows a lot about how to invest wisely, smart. He's had a lot of success over the years. So, I think people are sort of looking and say, well, what's gone wrong at Smithson? Is it anything in particular?
Yeah, absolutely. And I think what's also been interesting is Saba has taken a new angle to go after the investment trust world as well as kind of these typical investments. They are creating an ETF that would invest in some of these investment trusts. And the idea is that it could help narrow the discount and allow for the investment in a group of trusts through one ETF. It could also create some more leverage for Saba, so it'd be interesting to see what they decided to do with that. They run a similar product in the US, which is another ETF. Interestingly, it comes at a pretty hefty fee to investors, so that'll be something to watch out for if all of this gets approved.
I mean, the idea of buying an ETF that then invested in sort of seemingly cheap investment trust, that's not, we're not used to seeing things like that in the UK. Yes, there are a couple of products. One is the MyGo investment trust, which does do that, but it's not, I wouldn't say it's sort of a mainstream product. I get the impression that Saba wants to sort of have something that would have mass appeal, and I think to do that, it would really need to invest in some sort of large, sort of liquid trusts. I was reading some suggestions from people in the industry saying, like, names like it might take stakes in Bankers, in Lowland, in Mercantile, but I guess the key question here is like, what's going to be the catalyst to narrow these discounts? Is it really just wrapping up a load of different trusts under one wrapper, and then having a sort of a very broad campaign, or actually is it going to still have to go to one by one to talk to managers to say, like, now you're part of this ETF which we own, you've got a broad base of shareholders here, you've got to do something different to manage the problems and narrow that discount. So there's lots of unknowns about this ETF. When we get confirmation that it's actually happening, and it is ready to come to market, and we'll have more details, particularly stuff like fees, which Hannah's talked about. We'll talk about it on this podcast, or whether it's just on the weekly Edge Above Money and Markets podcast. But I don't think it's going to be something that they will be able to launch easily. Be interesting to see if there'll be actually big demand for it or not.
Yeah, it is. It's kind of a strange intersection of ETFs, which maybe have the impression of a little bit of a more new age product, and investment trusts that have been around for ages. So I would be very interested to see the kind of consumer that this is really appealing to, but I guess we might get to find out.
Yeah, it's probably worth just saying, I mentioned MyGo a minute ago. Just to clarify, that's actually an investment trust investing in other investment trusts. It's not an ETF. But yeah, in terms of an ETF investing in other investment trusts, that's a new world for what we have in the UK at the moment.
Yeah, absolutely. Well, right. It's time to talk about investing in the UK. The government would love more people to invest domestically, and the UK stock market has been doing really well this year. However, there are still many skeptics who believe the UK isn't a great place to put your money. To explore the situation further, Dan caught up with a couple of investment trust managers to get their take on events and to find out why they are still optimistic. First up, we're going to hear from Ian Lance at Temple Bar, a UK-focused investment trust whose share price is up 39% over the past 12 months and has nearly doubled in price in the past 3 years. Let's hear that interview now.
Well, I'm very pleased to be joined by Ian Lance from Temple Bar Investment Trust. So, Ian, great to see you. Hope you're well.
I'm very well. Good to see you, Dan.
Well, I think let's start off with Temple Bar's absolutely fantastic performance recently. What do you think there's a particular reason why the investment trust has done so well? Is it a market-wide re-rating, or simply down to clever stock picking?
I mean, the market obviously has done quite well, but we have done better. So the stock picking has been good. So to put some numbers on this, over the last year, the UK market's up 11. The Temple Bar NAV is up 25, and the share price up 35%. So the share price has trebled the UK market, and there are sort of various reasons for that. What's done really well. Financials have done well for us, so all the banks have done well. Insurance companies have done well. Airlines have done well. So IAG is up about 100% in the last year. So some weird ones that you maybe wouldn't have expected. BT is up 80% over the last sort of 18 months or so, and Currys, the electrical retailer at the start of 24 was about 45p. It's £1.36 today. So that the sort of performance has come from different areas, and I guess if I had to sort of summarize the message from that, I would say three things. Number one is, contrary to what a lot of people say, I think it shows that active investing does still work. Secondly, I think it shows you can make decent money out of UK equities. And finally, I would say, very pleasingly, it shows value investing is not dead, as some people were saying a few years ago.
Yeah, absolutely. I reckon if you went back a year ago, you would never have, if someone said, what do you reckon you'll achieve in the next 12 months? You would never think of 30% plus, would you? I mean, that's so. I guess if someone's watching or listening to this thinking, what could I potentially make on UK shares? I don't think that's an accurate sort of marker, is it, going forward?
It's not, but one thing that we are actually saying to people is just be very wary of anchoring. And what we mean by that is you can look at, so I mentioned the banks earlier on. So, something like NatWest Bank was up 100% last year and it's up another 40% this year. And then you go and look at the valuation of it and it's trading on less than 10 times earnings. And so I suppose the point that we're trying to make to people is that part of the reason that the returns have been so good is because valuations were just extraordinarily low sort of 18 months or so ago. And so, don't assume, I suppose what I'm saying is that it's all done and dusted, because again, to give you another figure, the PE on across the trust is still the average PE is just below 10. And that is definitely towards the low end of the time that Nick and I have been managing money. So you're right. It's unlikely we're going to see sorts of returns that we've seen in kind of in the last year or so. But the journey isn't over, I suppose is what I'm saying.
Yeah, I mean, there's quite a bit of talk about foreign investors starting to become a bit more interested in the stock market. They seem to have turned their backs on it, for quite a long time. I'm just wondering if you've seen any evidence in this, and is that kind of been triggered because of it's been strong performance, or there's been lots of takeovers, or is there something else, or is this simply just not true? They're not actually interested in it.
I think we are starting to see that. So there was an article in the Times, wasn't there, a couple of weekends ago, that was sort of saying that US investors are starting to turn their attentions to UK equities, and I think that is to a certain extent because in the last year or so, actually you've done quite well out of UK equities, and as a UK investor, potentially better than you've done out of the US stock market. So that's one thing. We've seen whole rafts of bids coming in from US companies for UK companies. That's the second thing. And then the third thing, you asked, have we seen any sign of that? And the answer is yes. And interestingly, we had a call with a US family office about 6 months or so ago. And following that call, they invested in Temple Bar. And so, that sort of thing would have been unheard of, I think, a couple of years ago. So, it does feel like they are actually beginning to look at UK equities again.
So obviously the UK government's quite keen for the public, particularly, to be more interested and put more money into the stock market. They also would like pension funds to do the same. Do you reckon they can find the magic solution to attract more buyers for UK shares?
Yeah, this is a difficult one because, yes, I think there are things they can do. From everything I'm reading at the moment, it doesn't look like they're about to do them. And, some of the things that you read at the moment, it almost looks as if they might be doing actually the opposite. So I guess we all know, don't we, that, Rachel Reeve has brought in a chap called Torsten Bell, who used to be at the Resolution Foundation, to kind of work on her budget. If you look at some of the policies that he has proposed in the past, it's things like, capping the ISA at the ISA at £100,000, scrapping the ISA, increasing the tax on dividends, wealth taxes, etc., etc., etc. So, yes, there are definitely things they could do. And what I'm hoping is that all these scare stories never come to fruition, because I don't think they're going to be very good for the economy if they do follow through on some of these things that you're hearing about at the moment.
Yeah. One of the stocks in your portfolio, Shell, continually seems to be a bit of talk about, could it be the next company on the UK stock market to switch its main stock listing to America, potentially to get a higher valuation? I'm just wondering that if that actually happened, do you think that would actually be extremely negative for the reputation of the UK stock market? I mean, because it's such this big beast, it's like, it's one of the biggest companies by weighting on the UK stock market. So if it essentially left, what does that really say about the traction of what's left?
Yeah, that and there are other similar companies, aren't there? So another one that's often mentioned is AstraZeneca, that they could move their listing. Undoubtedly, it would be bad. Although ironically, I think it might be good news from the point of view of an event like that might be the sort of thing that actually would really wake the government up and make them realise that they have got to take some action to make the UK stock market more favourable for UK investors and for UK companies. So it might be sort of short-term bad news, long-term good news, if you want to think about it like that.
Yeah, definitely. Now, there's a couple of stocks in your portfolio which have been subject to activist investors. Smith and Nephew and Johnson Matthey are the ones I'm thinking about. So I wonder if you could just talk through those stocks. Or I guess part of you're looking for value, but you're also looking for companies that aren't simply broken. Ones that could be fixed, and there's a catalyst to drive change. So let's we start with Smith and Nephew. That seems to be on, ironically for a medical business, seems to be on the the hospital bed for many years. Is it getting better now finally?
Yes, it is. It is. So, for I guess listeners who don't really know Smith and Nephew, it's got three businesses. It's got a hip and knees business, so it does hip replacements, knee replacements. It's got sports medicine, so if you're having, if you've torn your cartilage or that sort of thing, that business. And then it's got one called advanced wound management, which is basically, I suppose the wounds that are associated with surgery, that type of thing. The last two that I mentioned are really, really good businesses. So their top line grows at sort of 5% or so, and they are 20% plus margin type businesses. And those two businesses were 75% of the profits of the business. And then the bit that, inverted commas, gone wrong is the what's called orthopedics, so the hip and knee. And during the pandemic, that business did very, very badly for reasons that I won't go into. And the share price of Smith and Nephew got cut in half following this. And it was the sort of situation where there was a change in management, so a new management team comes in with a 12-point plan to improve the business. 6 of the 12 are focused on the ortho business. And actually, we thought, if they are able to do that, then, long term, we thought there was a lot of value in Smith and Nephew. And you're right, there's an activist here in the form of a company called Sevian. And so I guess we've been buying that for the last 6 months or so. And I think we timed it quite well, actually, because the last couple of sets of results have shown actually the new management plan is starting to work and the ortho business is beginning to turn up quite significantly. They've announced a big share buyback. So that one was slightly unusual for us in that it wasn't trading on sort of very low headline multiples. It wasn't your sort of classic value stock from that point of view. But it was the sort of business where if you look at 5 years and you think that they can improve the business, it did look very cheap. And in our opinion, it was a very high quality business.
Yeah. What about Johnson Matthey then? What's been going on?
Yeah, so Johnson Matthey slightly different. So Johnson, again, for those who don't know it, Johnson Matthey are involved in PGM, so platinum group metals, and they're a refiner of platinum and a recycler of platinum. The biggest demand for platinum is to go into catalysts that goes into exhaust, obviously. And I think I suppose the bear case on the stock and even maybe the whole industry was, basically the transition from diesels and petrol cars to electric cars, which obviously don't need catalysts. And so people basically could see demand, for platinum running off. And then the company themselves had tried to deal with that threat by basically moving into other businesses. They say, to give you an example, hydrogen. So they'd taken a lot of the cash flow of the existing business and basically poured that into new areas, what you might call transition areas, which hadn't really come to fruition. So they were sort of, losing lots of money in these areas. There was an activist involved in this. There was a company called Standard Investments, who are actually a similar sort of business to Johnson Matthey, but they also have an investment arm that had taken an 11% stake in Johnson Matthey, and they wrote some pretty forceful letters to the management of Johnson Matthey, which they made public, in which they basically said, look, you've got to stop wasting money on this, on trying to diversify into these other areas and go back to your sort of core business, and you basically just got to try and take costs out of your core business and improve the profitability. And the management finally responded to doing this. And again, just to give you some figures here, again, we were quite lucky with the timing of this. We bought Johnson Matthey. The market cap of the company was about 2 billion. So you could call this a sort of mid-cap company. And then they, literally a few weeks after we finished buying it, they announced the sale of a business called Catalyst Technologies to Honeywell, the big US firm. And the sale price was 1.8 billion. So you got back nearly the market cap of the company in the sale of one business, which only contributed about 20% of the profits. So, share price, I think, went up about 30% on the day or something like that. And it's sort of, I think that demonstrated to the market the tremendous value there was within Johnson Matthey. But actually, I suppose the new strategy has really only just started to come into play. I.e., they are taking money out of areas like hydrogen. So they're stopping investing in that. They are taking costs out of their core businesses, and it does appear to be coming through. So I think there was a sort of reset upwards following that transaction, but we still think there's plenty to go for as the strategy comes through over the next few years.
I hope you enjoyed that interview with Ian Litz from Temple Bar. He's a regular on the AJ Bell Money Markets podcast and always has interesting things to say. Next up, we're going to hear from James Harries at the STS Global Growth and Income Trust. James is permitted to invest anywhere in the world, but he chooses to have a big chunk in the UK. Let's see why.
I'm very pleased to be joined by James Harries from STS Global Income and Growth Trust. So James, brilliant to see you. Hope you're well.
Hello, thanks for having me on.
I think if you look at a global stock market tracker fund, the US should represent about nearly 3/4 of the portfolio by weight. But in the UK would only be a really small amount, about 4%. Now, your product, the STS Global Income Growth Trust, you've got 43% in the US, but 32% in the UK. So clearly a much bigger proportion of the UK versus, say, someone who just have a tracker fund. Could you just explain to me, why have you got such a high weighting to the UK? You obviously see some big opportunities here.
Absolutely. Well, it's a bit unusual in the sense that we at Troy don't really invest on a geographic basis. I mean, if we went back a lot of years, right back to the beginning of my career, we spend a lot of time talking about, should we add a couple of percent to Europe or take a couple of percent from Asia? But actually, what you should be thinking about is where businesses make money. And so although at a listed level, i.e. companies where they're listed in the globe, we have quite a high proportion towards the UK. On an underlying revenue basis, we've actually got very limited. So we've got 30-ish% listed in the UK. On an underlying revenue basis, more like 7%. So actually our exposure on an economic basis, on where companies actually make money, is relatively limited. In addition, though, the UK, unfortunately, for all the reasons we know, has been in the sort of capital markets doghouse for really quite a long time. And what that meant for all the reasons we know, and what that meant was that there were some specific opportunities in the UK, but in global businesses that trade around the world, that we thought looked idiosyncratically cheap. And so for a global income manager, yes, I'm based in the UK, and you could accuse me of so-called home bias, but actually there were some fantastic global income assets listed in the UK, and we took advantage of that.
Well, the UK hasn't always been such a sort of small component of the global stock market. I'm just trying to think back, maybe 20, 25 years ago, it was about 10%, I think. So,
Got that, yeah.
Yeah. Why is it that the proportion has shrunk so much? Is that simply a factor of the US part has just got really big? It's got some really very, very big valuable companies there. It was also because quite UK stock markets lost quite a few big companies to takeovers and mergers.
Well, it's that. There's a number of things at play here. Don't forget that pre-global financial crisis, we had some very large financial institutions, and actually the makeup of the index in the UK as a whole has quite a big role to play here. So we have quite big exposure to commodities, to mining, to financial services, banks, insurance companies, and so on, to defense and so on. And the reality is that these sectors, particularly post the global financial crisis in 2008, have suffered really quite a long bear market. I mean, they've been really quite poor for really quite a long period of time. And that's meant that on a relative basis, the UK market hasn't kept up. At the same time, you've had this amazing value creation boom, bull market, however you wish to describe it, particularly in the US, which has, of course, significantly outperformed the UK and significantly increased in terms of market cap. And then there is the third factor. You're absolutely right that at the margin, the UK has begun to be seen as a slightly less attractive place to list. And therefore, we haven't seen as many companies coming to the market as perhaps we used to. And at the same time, and related to the reason why I probably got more in the UK than I had for a long time, is that UK assets got cheap, and therefore quite a lot of businesses got bought. So you put all that together, And it means that the UK market as a whole has diminished in terms of its overall weighting in the global index, yes.
Because I was looking at performance statistics for this year. The UK's actually done pretty well relative to other parts of the world. But then if you look at data that shows money going in and out of open-ended funds, there's still money coming out of UK funds. So it seems a bit of a strange situation where you've got good stock market performance, but investors still aren't interested in. Is there any sort of logical reason why you think that might be?
Well, I always think, well, yeah, I mean, first of all, the stock market doesn't know who owns it. So flows are only one part of the picture. And although flows can be quite impactful in the short term, the long term is really what's going on in the underlying businesses in terms of growth and free cash flow. And just as I was saying that a number of the sectors that have done poorly for a period of time, up until quite recently, they've actually begun to perform much better. So the banks in this country have begun to do a lot better. Admiral Insurance, which we own, has done very well. Some of the consumer staples companies have done very well. So I think there's been a combination of greater global investor interest in UK assets and the fact that the sort of things, and so of course defense post the invasion of Ukraine. So it's been a combination of greater interest, but also the fact that what the UK market has been doing a bit better relative to other markets around the world.
Well, just let's touch on a couple of stocks. You mentioned Admiral there. Obviously, that's still a part of your portfolio now. So I think anyone watching this or listening to this will they'll know Admiral does car insurance, home insurance. But what is it about that business that perhaps has caught your eye?
Yeah, well, I'm a customer of Admiral. I think they're really good. I mean, first of all, their customer service, which is important in these sort of industries, is excellent. I'm a very happy customer. But actually, Admiral's slightly unusual in the sense that it's, first of all, it's an insurance company. It's the only one we own. Generally, insurance companies we find to be a bit opaque for us, a bit hard to understand and a bit hard to analyze. But and secondly, it's a domestic UK business predominantly. They do have some overseas, but it's basically a UK domestic business. And again, that's quite unusual in our fund, it being a global fund. What's interesting about Admiral, though, it's a really special business. Admiral are really, really good operators. And what that means is that they actually make a profit in terms of their underwriting. They actually make a profit in terms of the insuring that they do. And it may have come as a surprise to people that most insurance companies don't actually make a profit on that. They make a profit on the investments that they have, that they get as a result of the business that they do. But because Admiral has what's called a very low combined ratio, they actually make a profit in what they do. They can then outsource, if you like, some of their insurance risk to Munich Reinsurer, which is a very large German reinsurer, but retain the profitability. So they offload the risk, but retain the cash flow. And what that means is you end up with a very high return on capital business, which is just a phenomenally profitable enterprise. The final piece in the puzzle, if you like, is they're also great operators in terms of pricing and in terms of being very smart with regard to the insurance cycle. Because as we all know as consumers to our cost, insurance sometimes is more expensive and sometimes less expensive, and this tends to be quite cyclical. Clearly, we've been through a period of what they call hardening insurance rates, i.e. insurance rates have been going up post-COVID. And they've navigated this brilliantly. They tend to take market share when they're able to. They price when they're able to, but they're also quite smart about not writing too much businesses when pricing is not attractive. So you put all of that together, and it's a really excellent business that we're very happy to have in the portfolio.
Well, there's another one I want to ask you about, and that was Reckitt. People might know, previously called Reckitt Benckiser. So that business is, it's incredibly big. It's got a really good reputation. It's had a few wobbles in recent years, sort of question marks about some of its acquisitions. What is it that you like about that one now? Is it because you been able to buy into it cheaply because a lot of bad news seems to be priced into it, or have you been a sort of a long-term shareholder in that one?
Yeah, unfortunately, it is the latter. We've held it probably. We invested it prematurely. I mean, let's go back to basics. At base, Reckitt is an attractive business. It operates in attractive categories and is an attractive business model. And what I mean by that, it's effectively in consumer health and in hygiene, and particularly in consumer health. When you're not feeling very well, you're not particularly sensitive to how much you pay for the thing that's going to make you feel better, and you tend to be very brand loyal. So in essence, that makes for an excellent business. It's kind of intersection between almost being a pharmaceutical company and a consumer company. So it's sort of health brands. And hygiene also is an attractive category. I mean, the core brand which they have is Finish, which is dishwasher tablets, which we all know to our cost are quite expensive. And but we tend to be, again, quite loyal to the thing that actually makes our dishwasher work. But what's interesting about that is not only is it being seen a lot of innovation over the years, it also, for that reason, has quite nice pricing power. But globally, there's lots of people who don't yet have a dishwasher. And so that is a growing industry. And as particularly in emerging markets, people increasingly do have dishwashers, then that benefits Reckitt. Now, the problem has been that they've had a number of one-off issues. You're quite right. They made an acquisition called Mead Johnson some years ago, which is infant nutrition, which in retrospect doesn't look that smart. And they also, it would seem, slightly underinvested in their business. Reckitt was always known as a very tightly managed business that bore down a great deal on costs. Now, generally speaking, bearing down on costs, if you're a shareholder, is a good thing. But if you slightly overdo it, then it can leave your business slightly underinvested and your brand slightly invested. And I fear that may be something that Reckitt somewhat suffered from. They've also had a very unfortunate case of litigation in the US relating to their infant formula, which we think is ultimately unjustified. But the US legal system being what it is, it's been it's hung over the share price as people have tried to work out what the liability for that court case might be. Ultimately, we think it won't be nearly as bad as the market thinks, but it has been impactful on the share price. But recently, what's interesting is Reckitt has got a newish chief executive, and they're following a very well-known path, if you like, for consumer staples companies who get themselves back on their feet. Effectively, what you end up doing is focusing in on your core brands, and they've done that by spinning out a division, what they've called Essential Home, which is some of their less profitable, less valuable, frankly, brands, and they've concentrated down on their core business. And ultimately, we think they probably will do the same with their infant formula business, but they have to clear this problem in the States before they do that. So what you end up with is a focused company that's once again right-sizing the cost base to the brands that they have. They are therefore having a renewed dynamism. They return to growth. Their margin structure is looking healthy, and yet we think because of all the problems that it's had, the valuation continues to look really attractive. So ultimately, you have a business that we like. It's got the competitive advantages that we look for in terms of brands and distribution. It's got a sort of margin structure and a profitability that we think is attractive, and it's being reinvigorated with a new chief executive at a time when the valuation doesn't yet reflect that. So you put it all together, and at this point, we think it's really attractive. And I think it's probably one of the assets which overseas investors are being attracted to as well.
Okay. And just one final question. Obviously, you're looking for a mixture of companies who can give you a mixture of income and growth. So I'm just wondering, why don't you have a bigger weighting to Asia? Because I think, looking at the fact sheets, 2%, or if you include Japan, it's 4%. I know you say you don't pick by region, you're picking by companies, but that part of the world's got quite a lot of companies that are really sort of strong, reliable dividend payers. I would have thought that would be sort of quite a good hunting ground for you.
Yeah, so a bit like we've got 30% in the UK, but actually on an underlying revenue basis, only 7%. Although on a listed basis, we only appear to have 4% in Asia. On an underlying revenue basis, it's very considerably more than that. It's more like 15 to 17%. So we have a really decent allocation to that area. And what I mean, the reason I say that is because Asia as an environment, as a region, definitely is attractive for all the reasons we know. There is lots of people who are demographically, it's attractive. It tends to be a younger area outside China, of course. There are lots of people who are beginning to get to a level where they're beginning to consume, middle class, you might call it, but to a point where they have the sort of spending power that they can actually begin to buy the sorts of stuff which the companies that we have can make. And also, we tend to prefer to invest in businesses that are listed in the developed world or elsewhere that have businesses in Asia, because we find that they have better returns on capital. They often, not always, but they often have better corporate governance. And so to access the Asia dynamic, which you're sort of pointing to, we prefer to do it in companies that have businesses there rather than the listed there. Although one of the businesses we have in Asia is Nintendo, which has been absolutely fantastic for us. I don't know if you follow it, but it's launched the
Yeah.
Switch 2, which has been a knockout success, and so we're very happy with that. And so we have actually been reducing that slightly because it's done so well. But we were very happy to have it.
Thanks again to James Harries from the STS Global Income and Growth Trust.
Right, let's move on to something I think listeners might be quite surprised to hear about. So I think maybe you go back about 10 years ago, lots of people started to think about ESG, environmental, social, governance issues. And that might be, wanting to proactively invest in companies that are doing things to help the environment, or companies that are upholding really good corporate governance standards. It looked like there was a big wave of interest, but we then saw almost like what we call them sin stocks, so things like tobacco, oil, weapon manufacturers and stuff like that. So coming back into favor, and I think that the ESG sort of fad just faded away. So I think in recent years, a lot of people have been less interested in it. However, there now seems to be some suggestion it's coming back into fashion again. So Hannah, I know you've got some very interesting stats that you're going to want to talk about now.
Yeah, so we actually have someone unexpected to thank for the increase in ESG interest, which is US President Donald Trump, who is not at all a fan of ESG himself, but a study from the Association of Investment Companies said that Trump's attitude towards ESG has actually made 20% of private investors more positive towards ESG, and only 8% to be less favorable. So I don't know, sometimes you can see that if you hear someone's opposite extremes, it pushes you further towards your own beliefs. Maybe it's a case of that. But even though there's kind of concerns of greenwashing in the industry, and there's concerns of, policy in the US, Trump is kind of putting an end to a lot of the ESG policies. I suppose some momentum in that direction is better than nothing. Where actual investing is concerned, the picture gets a little more blurry. So even though there's a little more excitement towards the industry, only 20% of investors right now think that investing in ESG would up their performance. So it'll be interesting to see if this is more of a fad or if the money starts flowing in and it can become an actual shift back towards ESG.
Because I certainly know, I from speaking to various private investors recently, there's quite a lot of people who are taking the view that actually it's not all about, investing's not all about making as much money as possible. People do really value the choice that they could make in backing companies that do good in the world, or behave like good corporate citizens, and and I think that's really interesting, because I think people just assume it's all about wherever you put your money, it's all about making the biggest profit possible. But increasingly for people, they're going, no, it's not about that. It's not just about me. It's about what can these companies do over the next decade, the next 5 decades, and they're thinking about obviously the next generations in their family, how much they be affected by decisions that are made today. So I think that people are very quick to dismiss sort of ESG as saying, oh, it was a fad, no one's interested anymore. I think that's just not true. I think it's perhaps one for us to explore in more detail in a future podcast, and we would love to hear from any listeners or people watching this video on YouTube. How have you embraced ESG, or have your views on it changed in recent years? If you want to get in touch, it's podcast@ajbell.co.uk.
I was going to say, it is an interesting one, because we've seen so many movements. The most effective way to kind of get that change rolling is for people to put their money where their mouth is. So there is something that could come out of that could be a big change.
Obviously, we're talking about Donald Trump and the policies he's got. Clearly, the Trump administration, for his second term in the in the White House has had a big impact on markets. And actually, and we've talked about this on the podcast quite a lot. It's pushed people to think about, if they've been in the US quite heavily with their investment portfolio, where else might they want to look for opportunities? Now, we've talked about different geographic regions, but actually, we're now going to hear from someone who's looking at different places that you can invest. Not talking about different regions, but like actually investments that you might not normally find on broad mass market areas. So Hannah recently caught up with Majedie's Dan Higgins to understand about how he goes about investing, and it falls under the banner of endowment investing. So let's hear that interview now.
Thanks so much for coming on, Dan. I know you're here from the Majedie Investment Trust, and it's a little different than some of the trusts we've spoken about before. So I'm really excited to kind of get into the details of that and how that all works. How's your morning going so far?
So far, so good. Thank you for having me.
Yeah, excellent. Well, then we'll just jump right into it. So wondering if we could start this morning by just talking a bit about what endowment investing is. And I know there's some comparisons to what universities like Yale or Harvard do. What does your trust do, and how does it compare to that sort of investing?
Yeah, what do we mean by endowment investing, and in particular the liquid endowment approach that we pursue for Majedie? You're absolutely right. The endowment part refers to the fact that we emulate the investment mindset that has served the great university endowments in the States very well over time. And you mentioned Yale. David Svensson, who was the famous CIO of Yale, grew the value of its endowment from $1 billion to over $40 billion during his tenure. And we share many of the tenets that Svensson espoused so brilliantly, which are: we're very long-term, we're very fundamental, we target assets that have higher expected returns. So there's nothing in our portfolio that is purely there to dampen volatility or is a low return asset class. We don't do anything tactical. We don't try to time markets. We don't trade. And really importantly, we have a willingness to embrace differentiated and sometimes alternative return sources. And implicit in that is that active manager selection is really important. So those are all the endowment parts of liquid endowment, which we feel very strongly about. But where we differ from Svensson and many of the large university endowments is with respect to illiquidity. So Svensson argued that because university endowments were so long-term, that they could harvest higher returns by foregoing liquidity, that they could lock their capital up for long periods. So he referred to this as the illiquidity premium. We don't invest in illiquid assets for Majedie, so you won't find any private equity, any venture capital, any private credit, infrastructure, real estate in our portfolio. And that's for two reasons. The first is that our team's expertise lies primarily in marketable securities, things that you can get in and out of if you want to.
Mm-hmm.
Also because we just don't see any need to lock your capital up for multi-year periods in order to generate good inflation-beating returns in the world that we're now in. So yes, we share the mindset and philosophy behind the endowments, but what we do is liquid, and really importantly, it's marked to market. So the price of everything we invest in is independently verified, at least quarterly, and that's super important within the investment trust sector.
Yeah, I think that's really interesting, especially because there's been so much discussion about private markets at the moment, and a lot of people maybe finding more appeal there and wanting access to some of those markets. Why? I mean, what is your kind of take on that? And do you think that it's really necessary for most people to be accessing those private markets to get strong returns?
It's a big question, to which the short answer is no. I don't think it's really necessary. I'll try to explain why. So first of all, historically, and based on the historic evidence, one has definitely been able to earn premium returns by investing in less liquid assets. And I think that's for a number of reasons. One of which is that there's an argument that companies are better managed privately than publicly, that management teams can make decisions based on the long term and not try to appease fickle public market investors. And it's also been the case that a lot of innovation has occurred in private markets rather than in public markets. But it's also important to acknowledge that when one looks backwards, a lot of the returns from private markets have come from leverage, from cheap leverage, falling interest rates, rising markets that have enabled exits, especially for private strategies. And we think those conditions are not in place anymore. We think the world has changed, and that looking forward, interest rates are going to be structurally higher. There will still be cycles, but they're going to be structurally higher than they were before, that leverage will be less freely available, and we can't assume that public markets will keep going up, and that will provide an exit for private market strategies. And with respect to this illiquidity premium, this idea that you should earn a higher return to compensate you for locking your money up, we're just not convinced it exists anymore.
Okay.
Global private equity assets at the end of last year stood at around $7 trillion. That's more than doubled since 2017. And private credit, another very fashionable area at the moment, AUM in private credit surpassed $1.6 trillion at the end of last year. That's up from $400 billion a decade earlier. So this idea that there is a scarcity of capital chasing private market opportunities, I'm just not sure it holds water anymore.
Forgive me a little bit for my ignorance on this. A part of your portfolio I'm not very familiar with is the special investments. Can you talk about what that is exactly and how that kind of differs from something like a private investment? What is a special investment and how do those work?
So, in short, a special investment is an opportunity for Majedie's shareholders to participate alongside some of the world's great investors in their highest conviction ideas. Over 30 years or so of investing, our team here has built up a pretty extraordinary ideas network. And a few times each year, we get shown opportunities that very rarely, if at all, get on the radar of most other allocators. So what do I mean by that? Well, a special investment might be a co-investment in a public security. It might be a thematic opportunity. It might be a special purpose vehicle that someone has set up to pursue a very targeted idea. They tend to be have a finite life. And we have three criteria for our special investments. So the first is that it must come from a trusted source, somebody that we know through our network, who has something to lose as well as something to gain by bringing an idea to us. The second criterion is that the return potential must be potentially high. So for us, that means we need to believe it's possible to make at least 20% or more annualized returns from these ideas. And the third criterion, and this I think gets to the nub of your question, is we must feel we can realize the opportunity within 3 years or less. So although a bit of patience is required, these are not private market investments. Very often it will be a co-investment in a public security that might have an activist angle. So off the top of my head, always best to illustrate things with examples. Live opportunities within Majedie today include a co-investment in CVS Corporation, large US healthcare, and we've had a lot of a long history going back 5 or 6 years or longer in the listed uranium space, so uranium stocks. And the thesis behind that is that simply there is a lot more demand than there is supply, So the latest report to come out from the uranium industry suggested that demand, the 2040 projected demand is 20% higher now than it was a year ago. It's something like 40% higher now than it was 3 years ago. So demand is increasing and supply is very constrained. And there's also increasingly a political or strategic imperative for developed countries to secure uranium supply.
I mean, we have a lot of investors that maybe choose a group of stocks and then maybe look at some funds to choose. And you, I mean, are doing kind of a similar thing at a very different level, but are choosing active managers along with a group of equities. How do you go about balancing those different types of investments? And what is the one thing that you look for when you're looking at a fund or you're looking at a manager? What is the one thing that you need them to have to consider?
Diversification benefits. So in theory, the biggest investment in our portfolio should be something we feel very high conviction towards. It's liquid, it's not correlated, and it's not risky, and it's a brilliant diversifier. Now that's the holy grail for us. But we are constantly making dynamic decisions between the various components of our portfolio based on that. So at present, we are a little bit below the long-term target in our direct investments. Where we're finding opportunity is off the beaten track. So somewhat to my surprise, given how gloomy the outlook is for the UK economy at present, we have 4 or 5 direct investments that are listed here in the UK. We just think they're great companies, and if they were listed in other parts of the world, they'd be on much higher valuations. So that's Peer Group, the engineering company, IMI PLC, DCC, which is the kind of most unknown or under-researched component of the FTSE, in our opinion. Breedon, the aggregates company, and Computer Centre, which is the biggest single holding. Computer Centre is a company that sits between large corporations and providers of technology hardware, so is really and software, so is really exposed to investment in IT and infrastructure in that sector over time. And with respect to our external managers, again, a lot of the opportunity we see at the moment is outside the US. It's outside the mega cap growth stocks. We have negligible exposure to Magnificent Seven stocks at present. We're particularly positive on opportunities within Asia. So we have capital with a group called Niatros, which is a pan-Asian long-only manager. We have an allocation to a specialist Japanese manager called Strategic Capital, who are a small cap activist in Japan, where they still feel there's a vast amount of value to be unlocked if you have the knife with which to prise open the proverbial oyster. And then we feel we have a very non-consensual view on China as well, which again we're pursuing through an external manager, where we feel the market is underestimating the potential for stimulus to take effect, and in particular the importance of revitalizing the consumer in China to move away from a very infrastructure-led economy and making sure that people's savings get into the real economy. So as I say, everything's fungible, everything's different. We're acutely aware of where it's within our capability to do it or when we should outsource to someone else. That's another, maybe the final answer to your question is that our managers are all specialists. So we feel they are leading investors in area where specialists do very well at the expense of generalists. We are generalists. So if we're allocating out to mid-cap biotech specialist or a China specialist, or a third of the portfolio approximately is in specialist credit strategies, including stressed and distressed debt, which we feel is an incredibly high quality source of return at a time when generic bond markets don't look very attractive to us. So we feel we know some of the best credit investors in the world, and they're able to drive outcomes through their own actions by taking companies through restructurings or being discriminating providers of capital to individual companies. So we have the expertise to allocate those strategies. We don't have the expertise to do that sort of stuff ourselves.
Right. So it's looking at kind of those market niches and finding people that know it extremely well. Yeah.
That's everything. That's everything for us. Yeah.
So thanks again to Dan Higgins from Majedie to coming on the podcast. That's all we've got time for this episode. We'll be back with the normal AJ Bell Money and Market show later this week. The Investment Trust show comes out the first Monday of every month. Next time around, we'll be looking at renewable energy and infrastructure trusts. Really good place to find dividends, but actually the share price performance hasn't been great in parts of that market. So we're going to explore that topic in more detail. Until then, thanks very much for tuning in, and we'll catch you next time.
This podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell. The podcast isn't telling you if a certain investment is suitable or not. The value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.